Hello and welcome to Market Domination. I'm Josh Lipton alongside Alexander Canal, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Unfortunately, I think I would sell the shares. I just don't see a clear path to a turnaround here. And it's really just in the US where we have a lot of reimbursement pressure in the pharmacy, where we have a weak consumer. And I think it's just in structural decline. And despite new management, despite maybe selling off some non-core assets, I don't really see a turnaround here.
You're looking at mid-30s type of CapEx. Or capital intensity rate going into next year probably compares to about 32% here this year. So it's going to grow faster than revenue next year, but that should be expected because of the growth opportunities there related to high bandwidth memory. So overall, it's somewhat of a mixed picture, but Micron is kind of trending in the right direction here.
It took 3 months, right, for him to say that they were losing confidence in the path of inflation. So we've got a little bit of time here where things have been coming in weaker than expected. I don't think just a few reports and a few weeks' time is going to change the outlook for them right now.
All right, we've got 1 hour to go until the market close. Stocks are mixed, fighting for some gains here. Let's get it out to Jared Blickery for a check on today's action. Jared.
All right, well, let's dial up the big board here. We have the S&P 500 under a little bit of water, but let's look at the amounts here. 5 basis points, basically nothing. 3 points, not seeing a lot of action. You can look at the Nasdaq. That's up a little bit more, up about 27 basis points. And then we can also look at the VIX. And the VIX has been is actually by historic lows right now. And you can see that's barely changed throughout the day. And if we get a look at the sector action, guess what? And it will take me a second here to dial that up, but there we go. We've seen XLC, that is communication services, consumer discretionary, and tech. Those are the 3 leaders here. Real estate also in the green, but this is a story of mega caps for the day. Guys?
Thanks so much, Jared. Well, stocks are mixed as investors weigh a new batch of economic data, including a key inflation reading on Friday, PCE. Joining us now is Tom Hanlon, U.S. Bank Wealth Management Senior Investment Strategist. And Tom, let's start with some of that econ data that we got this morning, in particular, continuing claims, that number hitting the highest level in more than 2 years. Do you see this as a normalization of the labor market, or is it an indicator that higher rates are hurting the U.S. economy?
Yeah, thanks, Alexander. We saw the data this morning. It suggests that the Fed's rates are having an impact on the economy and in the way that they are anticipating, which is kind of gently slowing the labor market, gently slowing investment and economic activity so that they can go ahead and move forward then moving forward to interest rate cuts perhaps in the second half in the fourth quarter of this year. So that was kind of almost like a bad news is good news type of economic print this morning, where the numbers weren't so bad to suggest that we're having a sudden contraction in the economy, but that these rates are starting to have an impact.
Tom, as I read through your notes, you sound constructive on the stock market, Tom, but maybe, the vibe I get is kind of cautiously constructive. Am I reading that right, Tom?
Yeah, Josh, if we look at just the kind of the pillars of growth, inflation, and interest rates, even though the data was a little soft, it's still a positive economy. Inflation will get a new reading tomorrow on the PCE, as Alexandra alluded to. We have positive but decelerating inflation, and Treasury yields have kind of stabilized here around 4.25. We think that's a pretty good setup for stocks to price higher, at least at the broad index level. And then, as you mentioned earlier, in terms of performance, we still think those secular growth, large cap tech names are still likely to carry the market forward, just because that's where you see the greatest visibility in terms of sales and earnings growth. But we pair those technology-oriented investments with some additional sectors, like those dividend-paying sectors, like consumer staples and some select healthcare names, and some of those like non-office real estate sectors, where if you do get rate cuts in the second half of the year, you get some less competition from Treasury yields, and that kind of helps those dividend payers look more attractive.
So Tom, in terms of portfolio positioning, considering that there are some overhanging risks, we don't know if and when we are going to be seeing those rate cuts, would you say, would you advise your clients to be more offensive or defensive at this point?
Yeah, Alexandra, our recommendations have been to kind of tilt more towards those positive growth and inflation-sensitive assets. So for a typical diversified investor, they've got some allocations to stocks and bonds and things we call real assets. We would have some of that money out of core bonds and into those U.S. large cap equities, but also pairing that with things like inflation-protected bonds and commodities. Again, inflation's coming down, but it's still above the Fed's target rate. It's still positive, and typically those assets tend to do well in that scenario.
Tom, I want to get your take on the AI trade as well, which of course has been a big theme for investors. Micron, reported last night that stock, roared into that print, Tom. I mean, investors just bet that was another name that was going to benefit from this mega AI trend. It's getting hit today afterwards. Just as a strategist, how are you thinking about that trend, Tom, and how do you want to invest in it, if at all?
Yeah, Josh, we still see AI in this discovery phase. And so the ultimate demand for all the feedstock into it and the semiconductors and the cloud and the kind of the overlay of the user interface, that's still in play in terms of how many industries and how many companies see a productivity benefit in that. If we look at early in the kind of the robotics and automation phase, it took a while to figure out that was going to move into everything from the primary economy like mining and farming all the way into medical devices, robot-assisted surgeries and into the home in terms of like robotic vacuums. So we still think that AI is in an early stage of discovery of what it can do and what the ultimate users will do with it in terms of productivity. That will help determine ultimately the ultimate opportunity set there. So we still think it's early. We still think there's room for those assets supporting the AI investment continue to run. But again, in order to be a little bit more defensive, we would pair those again with some of those more dividend-oriented opportunities just to give you a little bit more ballast in that equity portfolio.
And Tom, we have a little thing coming up in November, the U.S. election, but we're seeing markets significantly outperform typical election years. Given that, do you view the election as a potential risk to stocks, and how should investors be positioning their portfolio ahead of November?
It's a unique setup, Alexander. I think this is the first time since in the post-war time when we've had a debate occur this early in June. You typically go through a process of the conventions and the nominees, and you start to see the platforms from each candidate, and then you have a debate to kind of flesh out the differences between the candidates. So definitely a unique setup for this evening's debate. The work we've done at US Bank, and we published it, you can find it doing a web search for how elections impact markets is, we still find a much more significant impact of that setup of growth and inflation and interest rates than ultimately which party resides in the White House or has control of either House of Congress. So we think this is still a good setup for stocks leading into the election. And typically you do have positive performance on election years where you have a candidate up for re-election, as is President Biden. But again, the path forward for the stock market is more likely to be determined by how does economic data come in? What's the Fed path around interest rates? Is inflation coming back to target? And that'll have a much stronger influence on capital market performance than perhaps the outcomes on November 5th.
Tom, we'll get you out of here on this. For fixed income investors who are listening right, Tom, what's your guidance? What's your advice to them?
When we say we're tilted towards equities and real assets, it doesn't mean we don't like fixed income here. We still think clients should have a healthy allocation there. Within the fixed income of the bond market, we still see opportunities for clients that don't pay taxes for those sort of institutions. We see areas around those part of the mortgage market that's not backed by agencies. Home prices are still strong. Homeowners are still having supported by a strong labor market and wage growth. So those non-agency mortgages within kind of those idiosyncratic areas of the bond market. For taxable investors, we still see a lot of value in municipal bonds and being able to go out in maturities, taking that extra yield that you get, and also high yield municipal bonds where default rates are historically pretty low and investors can earn additional yield there.
Tom, always good to see you and have you on the show. Thanks for joining us.
Josh, Alexander, thank you so much.
Well, Roaring Kitty, there you go, is back at it again. Best known, of course, for sparking the GameStop-led meme rally. The ex-user took to the social media site posting, there it is, a picture of the dog, and shares of Chewy went soaring for a short period of time. That was it. We had Chewy Pop on this. Keith Gill, of course, known around the world as Roaring Kitty. did post that image. I wish I had more to tell you on that, Allie, that there was company news or financial news. I don't. I have an image. I have an image of a dog, and that did it. That was enough.
Well, what's interesting to me is the Ryan Cohen piece of this all. He is the CEO of GameStop, and we did hear Keith Gill when he did that YouTube live stream a few weeks ago. He talked very positively about Ryan Cohen, and Ryan Cohen, of course, is a founder of Chewy. Now, it wasn't just Chewy. You're seeing on your screen now some of those other pet names that spiked on the news. Now, Petco is down at this point, but PetMed Express is still holding on to some gains there. It's just, the meme stock trade, there's not much to say about it. This is not based on fundamentals. I'm not surprised that we saw these moves because of the following that Keith Gill and Roaring Kitty has. But I don't think anything will hold here. We'll see if he comes out with another live stream.
The man has an army and he can move stock. It's remarkable because in 2021, I bet a lot of people thought this was like something that would kind of come and go. But here we are, Allie. June 2024, we're still talking about it. Mr. Gill. All right, we are just getting started here on market domination. Coming up, the Supreme Court has blocked Purdue Pharma's opioid settlement. We're going to break down what it means and who it may impact on the other side. Plus, mortgage rates continue to trend down, hitting the lowest level in almost 3 months. We're going to chat the latest housing hurdles later in the hour. And Nike is set to report its latest earnings report after the bell today. We're going to get you the numbers and instant analyst reaction as soon as they cross. Stay tuned, more market domination coming right up.
The Supreme Court rejecting the Purdue Pharma settlement that would have sent billions of dollars to treatment programs and victims of the nation's opioid epidemic. But it also shielded the family largely blamed for the epidemic from future lawsuits. Joining us now to help break this all down are Alexis Keenan and Anjali Kamlani. Alexis, what exactly did the Supreme Court decide today?
Okay, so what they said is that the bankruptcy code, and therefore a bankruptcy court, federal bankruptcy court, cannot release company owners who are not part of the bankruptcy proceedings from liabilities that may be pending against them. So in this case, you had Purdue's former owners, the billionaire members of the Sackler family. They agreed to pay $6 billion into a fund to settle all of the nation's opioid litigation. That includes individual plaintiffs, and that also includes state and local governments and other communities that had actions before them. Now, those plaintiffs, they want that money. They're disappointed here that they're not going to get access now to that settlement because now that $6 billion is off the table. But the bankruptcy court had issue with the fact that the Sacklers were not part of this bankruptcy because they, over a 10-year period, took $11 billion out of the company for their personal fortunes and then saw only $6 billion of that come back for these settlements. You had Justice Gorsuch, who wrote this 5-4 decision, calling it a milking program, taking all that money out of the company. And that $11 billion, when you put it into perspective, it amounted to 75% of Purdue's total assets at the time. So this was all pre-bankruptcy that they were bringing this money out of the company.
Now, Anjo, over to you. Just get your take on this. What you think it means? Just interested. What do you think it means for Purdue? Looking forward as a company. Who I was reading reports saying they've been upfront saying, listen, we may not survive if the Chapter 11 were rejected.
Right, and this is why this delays a lot of the justice that not just the victims are looking for in the patients themselves and the families rather of those who took the drugs, but also of the governments that are looking to create programs as well as the hospitals that are looking for reimbursement. So all of that gets put on pause until the Sacklers come back to the negotiating table. But also what it does for the company is part of this was that the Purdue name would go away and that a new company sort of set up like a public trust under the name Noah Pharma would come into play. And that the funds from the products it would sell, which included, by the way, an opioid overdose reversal treatment, in addition to other painkillers, OxyContin being one of them that would continue as part of the brand. All of the proceeds from those sales would then fund all of these settlements because as a company cannot already pay out the, $51 billion, that's part of it, and whatever else is pending and left and future lawsuits. So all of that put together, this is sort of where the company's supposed to be going, and that is now also delayed as a result.
All right, big story. Thank you both for covering it for us. Appreciate it, Anj and Alexis. Moving on to some of today's top trending tickers. Let's get to some of those. Let's start off here with Walgreens. Those shares, check that out, plummeting after missing on third quarter earnings, announcing a plan to close a significant portion of underperforming stores. You can see the move down. We're about 25% lower here. And just to put that in perspective, by the way, Bloomberg pointed out that that is the worst intraday drop, going back to at least 1980. You're hitting lowest levels since 1997. Drugstore chain, listen, it cuts its profit forecast for the full year, talks about this, tough consumer backdrop and environment. It is going to close some of those stores. CEO Tim Wentworth saying we continue to face a difficult operating environment, including persistent pressures on the U.S. consumer and the impact of recent marketplace dynamics, which he noted have eroded pharmacy margins.
Right, and these headwinds are expected to persist into 2025. You were just talking about Tim Wentworth and what he said on the earnings call. He said, quote, changes are imminent for about 25% of the company stores that are underperforming, and that translates to about 2,100 stores that could be shut down if conditions don't improve. Now, Walgreens, they already closed 2,000 locations over the last decade or so, and Wentworth even admitted that the company's at a point where the pharmacy market, it's not sustainable. And if you think of some of those newer entrants on the market, whether you think of an Amazon or other discount retailers, there are other options for consumers to go to, especially in this high inflationary environment. So definitely not a great day for Walgreens. I mean, those stats were just crazy. The biggest intraday drop, I want to reiterate, since 1980.
Yeah, the CEO, the CEO did talk about how they're focused on improving their core business, retail pharmacy, working, he said, to unlock opportunities for growth, but investors, at least today, clearly not waiting around.
Yeah. Another stock I have my eye on is Palantir Technologies. The stock is climbing after announcing a new partnership with Voyager Space to leverage artificial intelligence to drive innovation in space tech. Now you're seeing Palantir shares up just under 5% right now on the heels of this new partnership. According to a press release, both Voyager and Palantir will, quote, rapidly advance the space and defense technology sectors by integrating Palantir's cutting-edge AI tools across the Voyager enterprise. Now, this partnership is also going to enhance military research and development, along with making space more accessible to the defense community, which I thought was interesting. And to me, this is just another example of the expansion of AI into various sectors, into various industries, how you can utilize this technology. Palantir also previously formed a strategic partnership with Starlab Space. So it seems like this is an area where Palantir wants to continue to explore, and clearly a use case for AI when it comes to that goal.
Yeah, you saw Palantir's execs kind of saying in a statement with this news that the company's committed, they are to building transformative AI solutions across every domain. And that, of course, it's a big part of the bull thesis here on Palantir, that this is a smart AI play. Not everybody believes that. Listen, there are skeptics, but we've had fans like Dan Ives over at Wedbush calls Palantir the Messi of AI.
Right.
And I actually, I was at a Palantir customer conference in Palo Alto, California, where a lot of the customers were there. They took the stage. They would talk about how they were sort of integrating the company's AI technology. And we've spoken on Yahoo Finance with Palantir CEO Alex Karp, and certainly pounding a very confident, optimistic drum.
Yeah, and even if you take a look at the stock, it's up nearly 50% year to date, up about 80% on the year. So it's one of those names that is seeing the boost that we're seeing across the space when it comes to AI.
All right, last one here. It's got Blackberry. That stock's soaring after the release of their first quarter earnings, which did see revenue beat expectations. Of course, now Ali is a cybersecurity company, reports a narrower than expected quarterly loss here. It looks like a loss of 3 cents a share. Revenue did clock in at $133 million. That did beat expectations. Companies saying they are on track to be both profitable on a non-GAAP basis and generating positive cash flow in the fourth quarter. A pop today, though, it's been a rough go for Blackberry here.
Oh, yeah. I mean, just coming through some of these analyst notes here, RBC Capital has a $3 price target on the stocks, potentially more room to run there. And they said that visibility to near-term profitability is starting to improve. But that longer term, there are still challenges that remain, in particular when it comes to just the competition in this space. All that being said, though, it is encouraging to see that near-term stabilization in terms of those profits and the company's overall business. And that could help lift those valuation levels from some of the bottoms that we've seen. But like you said, I mean, year to date, the stock is struggling. And this is just something where I wonder what the future is for a type of company like this. But turning on for now to the housing space, mortgage rates, they are continuing to fall amid a sluggish housing market. Yahoo Finance's Danny Romero joins us here with more. So, Danny, what are the latest moves that we're seeing in mortgages, and how do you think this is going to impact really the industry moving forward?
Ali, mortgages are on the decline, and they have been for 4 consecutive months, and rates actually hit the lowest since April. The average 30-year fixed mortgage rate ticked down to 6.86% this week. That's according to Freddie Mac data. Now, despite this pullback in borrowing costs, rates are still flirting around that 7%. So many homeowners are still enjoying those lower mortgage rates and staying put in their home, while potential buyers are really challenged with these affordability hurdles right now in the housing market. And this has impacted housing activity. If we look at pending home sales, a leading indicator to the housing sector, that fell 2.1% in May. That's according to the National Association of Realtors. And on a yearly basis, pending transactions are still down 6.6%. So very sluggish recovery for this housing market.
It sounds like the same themes, Dan, that continue to play out. Demand, you talk to housing analysts, also demand's there, but affordability is just a problem.
Yeah, home prices are just so expensive right now.
Because there's no inventory. Is that the issue?
Well, it's stale inventory.
Yeah.
I was looking at some data today from Redfin. They said 60% of the listings, the active listings of homes that are out there, are stale, meaning that people are not really interested in the homes that are really out there. And that obviously depends on a customer basis, right, what you're looking for in a home. But we also have to realize that even the pandemic boom towns are not, people are relocating. They have to move back, whether they have to go back to the office, right? People are not flocking to these certain areas where affordable homes are available, right? So we're seeing kind of this slowish movement of activity in Florida, Texas, the southern and Midwest regions, which during the pandemic were such a great booming, I would say, during that time. But yes, there is demand. Really, people are not impressed with what is listed out there, which is why people are cutting home prices right now.
All right, Danny, thank you. Always appreciate it. Let's stick with this. U.S. pending home sales fallen more than expected in May, while new home sales hit a 6-month low. Housing affordability, as we were just discussing, that's weighing on potential buyers as home prices have been hitting highs, and that has many people still renting with hopes of home ownership slipping away. We're looking at the alternative build-to-rent market with Kinlock Partners co-founder and CEO Bruce McNeilage. Bruce, it is good to have you back on the show. And I don't know if you heard that discussion, Bruce. Listen, I'm looking at the 30-year fixed here, Bruce. Mortgage News Daily tells me it's 7.05%. I mean, okay, we're below the 8%, Bruce, we saw late last year. I guess that's a plus. But if the 30-year fixed is going to stay around these levels, Bruce, what does that mean for you and your business? Does that just mean, listen, more and more people think, I'm priced out, I'm not owning, I'm going to look more at renting?
Josh, yes, that's correct. People are giving up. They're giving up for the time being. And what we're being told is rates have to go down to about 5.5% before those people are looking to get into the market. And then, of course, trying to find a house they can afford. Houses are not going down in prices. So what we found is people are staying put if they own, but we're getting more and more applicants every time we have a vacancy, and we're 98% leased. Our industry is 98% leased, so there's not a lot of room, not a lot of places people can go.
So you said 5.5% is where mortgage rates need to fall for folks to get back into the market. When do you expect that to happen? Bank of America was out with a new note warning that the housing market could be stuck until 2026. Is that a realistic timeline in your view?
Yeah, there's a saying, stay alive till 25. I think it's going to be like pick up in 26. And so it's not coming down anytime soon. The price of houses is not coming down. People are going to have to rent longer than they think. And I think you're looking at least Q3, Q4 before we get anywhere near that number. And that's next Q3, Q4 next year.
And Bruce, who's coming to you? I mean, who wants to rent right now? What's the demo? What's the average customer? Man, woman, young, old, income level? What can you tell us?
That's a great question. Our average tenant is in their 30s to 40s. They have 2 kids. And the average income of our tenant is $126,000 a year. And when we started the company, people rented out of necessity. They didn't have choices. Now many people are renting out of choice. They like the lock and leave lifestyle. They like the ability to call the landlord, if the roof leaks or there's some problem. Plus we have brand new. So people have a tendency of staying longer, and those people have 2 or 3 kids. They can't live in an apartment in the city. They don't want to share walls. They don't want to have 2 bedrooms. They want a 4-bedroom in the suburbs with a backyard and a garage. That's what we are offering them.
So 4-bedroom in the suburbs. In terms of regions in the U.S., where are you seeing increased demand, and what areas are still pretty sticky when it comes to those high rent prices?
Yeah, you have the Smile States, which is basically the Southeast, down through Texas and up through Arizona and that area. And that's where a lot of your migration is. So we're seeing a lot of activity there. We have new entrees coming. California seems like they're all moving to Nashville and to Texas. So we just see a greater demand. And the supply, quite frankly, isn't growing a lot because a lot of people in our industry have not been able to expand their houses and their holdings because of the cost of capital and debt to grow our businesses.
Bruce, I'm just interested for your business, how, pushing into the back half of this year, but also, 2025 and farther out, Bruce, how are you thinking about your business sort of just changing and evolving from here? What are next steps?
Well, I see our business, unfortunately, going to smaller houses. You look at all these cities, it's tough to get the density approved, but people are trying to get the density, builders, developers like us, to get enough houses on an acre to make it affordable to people. In the past, we've offered 4 and 5 bedroom houses. I see the rental market going more towards smaller 3 bedrooms, townhouses, somewhere between an apartment and a house, almost like a hybrid. 3 bedroom, 1 car garage. It's better than living in an apartment. It's just not quite as good as living in a large house.
And Bruce, when you look into your crystal ball here, what do you think is going to be the catalyst to revive this market? Is it dependent on if the Fed cuts rates and the impact that could have on mortgage rates? Is it dependent on new supply coming in the market? What are you watching as that catalyst here?
We're seeing more and more vacancies in the multifamily area. Nashville, you have 15% vacant units. Other cities, but then you have 2% of the single family rental houses vacant. And so I really see a migration of the Gen X, but also the millennials moving from the urban core, condos, apartments, and they're moving 30 miles, 30 minutes outside to the suburbs where you can get a backyard, where you can get parks and recreation, be close to interstates, be close to shopping. That's where the migration is. And you're not going to see that changing. I would not want to be in the multifamily business. And there's a lot of multifamily operators coming into the single family rental business.
Bruce, really interesting discussion. Thank you so much for joining us today. Appreciate it. Still to come, President Biden and former President Trump going head-to-head tonight on the debate stage. I'm going to tell you the top 3 things to watch when market domination returns. For the first time in U.S. history, a sitting president and former president will meet in a debate in what could be a pivotal moment in a neck-and-neck election. And joining us now is IXIC Boltansky, BTIG's Director of Policy Research. IXIC, it's good to see you. So the moment has come, IXIC. The big debate is here. Two men enter. What are you looking for, IXIC? What are you going to be watching for?
You know, first of all, I would just say if you're looking to feel good about the democracy, this might not be where you want to go this evening. Maybe you go watch, the end of Mr. Smith Goes to Washington, or, even the president's speech from Independence Day. Like, those would make you feel a little bit better about democracy than what we're going to see tonight. But, here's what I've told my clients. It's not going to be about policy tonight, right? It's going to be about presentation. And what I've heard from operatives and clients and market participants and everyone is it's going to be a real focus on the two C's. That's comportment and capacity. So for Trump, is he going to appear overly abrasive and rely on ad hominem attacks that turn off some voters at the margin? For Biden, is he going to look sharp? Is he going to look capable for another 4 years? So that's what I think we're looking for tonight. It's going to be much more about tone and appearance than it is going to be about policy substance.
Now, both Trump and Biden have, let's call them, very spirited camps of supporters, but there are still many Americans out there that are unsure. What do you think could be said tonight? What do you think people could see that could potentially sway either side?
Yeah, here's what I'm looking for. On the Biden side, I want to see how he responds to attacks about immigration and inflation. I think those are two key issues, especially when you really peel back the onion here and you realize this election is going to be decided by voters in just 6 states. And in those 6 states, immigration and inflation are two key areas of focus. And I think President Biden, is going to spend a lot of time talking about junk fees and beating up on corporate America, saying that they are driven by greedflation and shrinkflation and things like that. I don't know how that's going to play, so I'm interested to see what that is framed as tonight. On the Trump side, look, I think he's going to face really pointed questions about reproductive rights and his conviction. So let's see how that plays out. I mean, we've got to keep in mind the election is still 130 days away. This is the earliest we've ever had one of these debates. So we've got a long, long road ahead.
IXIC, how many people you think tune in and watch this tonight? You think viewership is meaningful? Because, on the one hand, it's the first debate. On the other hand, IXIC, it's summer. I mean, a lot of people, I don't know how many people think this is how they want to spend a summer evening, but what do you think?
Look, I think viewership is going to be meaningful. And I think really for me, what's most important is how does it play tomorrow, right? What sound bites do we get? What B-roll do we get? What video are we showing tomorrow morning on your channel and elsewhere? So whether it's a massive number or not, I don't know how much I care. I think a lot of this is about how it plays the following morning. And I can tell you, for folks in DC who aren't used to staying up that late, there's a lot of focus that's going to be placed on the last half hour of this 90-minute debate. Because again, I think everyone is looking to see how these two men who are hovering around being octogenarians are able to handle 90 minutes in this setting, and what that tells us about their capacity and mental faculty as it relates to their capacity to do another 4 years.
IXIC, I have a bit of a loaded question for you. What are the chances that it's not Trump versus Biden in the end and one of those candidates potentially drops out?
The chances are exceedingly low. I think that we need to all come to terms with the fact that this is going to be Biden v. Trump. Of course, anything is possible, especially on live TV, but I have seen nothing yet to suggest that any alternative is being contemplated. And I think that when we discuss that alternative, it is nothing more than hope driving it. There has been nothing from a substantive perspective suggesting that Biden will step aside. We have seen no work whatsoever from the party to point to another candidate. And then on the Trump side, he controls the party infrastructure as is. So look, I think this is Biden v. Trump, and I think we need to all buckle up because, again, it's going to be a long road.
IXIC, we know it's been neck and neck, this race, but have you seen anything in the polling, even slight shifts and changes, either nationally or in the swing states, that's kind of caught your eye, IXIC?
Yeah, look, so we spend a lot of time looking at the 6 states that will decide this. And I think the way that I've sort of split this up is you have 3 states that are the Sun Belt states, we're talking about Nevada, Georgia, and Arizona. And then you have, the Rust Belt states, if you will, and that's Wisconsin, Michigan, and Pennsylvania. Trump's lead in the Sun Belt continues to grow. And for that, I continue to look at immigration as an animating factor. That is one that I continue to see. And that lead that Trump has been sustained despite the Biden administration taking some steps on immigration and the southern border. So that's one thing that I continue to watch and I think is going to be key, especially as there's still expected to be another surge of migration at the southern border in the next few months.
You mentioned that hush money verdict for Trump. He was found guilty there. What do you think the chances are, though, that impacts his ability to win, especially when it comes to his base?
Yeah, I have heard a few thousand different opinions on how that verdict plays, and I don't think any of them have it right yet. I don't think any of us can really tell because this is complicated and there are nuances to it. Obviously, it has an impact on some swing voters, but you also saw a massive increase in Trump's fundraising around it, right? So none of this is cut and dry. I think it's all nebulous inherently. But what I'm going to be focused on tonight is how much of this evening is personal attacks, right? How much of it is Biden going after Trump for those convictions or Trump going after Biden for his son's conviction? And what does that do to the voter at the margin in terms of their willingness to show up at all, right? And I think that ultimately that's the one question that I continue asking myself is, who has the lead on enthusiasm, right? Because I do think it's going to be a lower voter turnout year, given that no one is that excited about these two candidates. And if that's right, I think that Trump is the leader in the clubhouse, at least a little bit, given that his voters tend to show up and tend to do so enthusiastically.
All right, well, a lot will be riding on that debate later tonight. IXIC Boltansky, thank you so much for joining us today. Let's get to some calls of the day here. JP Morgan raising its price target on Micron from $130 a share to $180. The chip maker also getting a price target increase from Needham along with TD Cowen. Now, it's interesting to see these price target raises after Micron's post-results sell-off and how that points to a lot of risk within some of these major AI chip makers. But JP Morgan still believes that Micron is well positioned. It's one of its top picks in the semiconductor space. JPM thinks the stock should continue to outperform through 2024 and into 2025, and that it believes markets will continue to discount improving revenue, margin, and earnings power there. And basically, the argument here is that we're very early in this cycle. Typically, in the memory industry, the upcycle is 6 to 8 quarters of positive EPS revision trends, and we are only 2 quarters in. So a lot of the messaging from these analysts, even if we talk about a huge name like Nvidia, is that there's still potential room to run here, and there's a lot more growth that could be had.
Yeah, I mean, you can see Micron there really taking it on the chin in today's trade. But I mean, a couple points. One is this stock, the expectations were just so sky high, Allie. Yeah. It had roared into that print because so many folks had piled in and thought this is a smart way to play that AI trend. So you see some selling today. To your point, worth noting, I mean, the street loves Micron. Mm-hmm. I mean, more than 90% of analysts think you should buy it at these levels. JP Morgan was one name. I saw Krish Sankar over at TD Cowen. He told his clients, listen, the selling today, he did realize, listen, in part it was that revenue outlook. He also said it was the CapEx guidance for 2025, suggesting, he says, near all-time high spending levels. But again, like JP Morgan, sticks with his buy.
Yeah, you have to beat and you have to raise pretty significantly with these names.
Moving on, cryptocurrency Solana is popping today after U.S. asset manager Van Eck filed for a Solana ETF with the Securities and Exchange Commission. The spot ETF application is the first for Solana in the U.S., and Jared Blickery is here with the details. Jared.
First came the spot Bitcoin ETFs and then the spot Ethereum ETFs or Ether. Those have not come to market, but now we just got the filing for a Solana, spot Solana ETF. Van Eck doing that filing, and you can see the results on the price action here. Solana up 8.5%, and guess where that news came in? You can see that big spike right there, and it wasn't limited to just Solana. I think this is pretty important because we saw the behemoth, Bitcoin got a bit of a spike in there, not quite as dramatic, but still still up at the same time frame. Then you have Ether. That was also another spike. And I think that's telling too, because the Ethereum network is a competitor to Solana and Cardano for that matter, when you're looking at smart contracts to be deployed. So overall, this has been a very bullish development. All these spot Bitcoin and Ether and now Solana ETFs, it allows the average investor to take part in some of these investments, especially when you take into consideration the crypto shy. So let me take a look at the longer term technicals. I'm going to start with Solana here. Here's a 5-year chart, and this is something I went through the other day. We haven't quite come up to eclipse those highs we saw in 2021. So it's a little bit of a different story from Bitcoin, but we are consolidating, maybe putting in a little bit of a handle here. We'll have to see what comes of it, but this is a bullish development in the long-term technicals for Solana.
Thanks, Jared. Keeping track on all the crypto moves for us. Appreciate it. Coming up, fast food value menus are making a major comeback this summer. We'll have more on the latest meal deals and the investment opportunities that follow. That's next on Market Domination. Taco Bell is jumping into the value competition. It is the latest fast food player to join a crowd of chains like McDonald's, Burger King, and KFC, looking to use value to get consumers back in the door. Yahoo Finance's Brooke DePalma is here with more. Brooke, how are value and innovation playing a role when it comes to getting consumers back to some of these restaurants?
Right, Allie. It's all in an attempt to turn around the narrative that consumers think that fast food is too expensive. So food chains are taking action to combat that narrative as they look to bring customers both back in with value and innovation. Now, to see if it's working, we went out to foot traffic analytics platform Placer.ai to get a closer look at overall foot traffic trends year to date. And what we found is that foot traffic is gaining a bit of momentum at the end of May to early June, underscoring that value and these lower price points seem to be resonating a bit with customers. And taking a closer look at Taco Bell specifically, as you noted, its value menu just dropped today. It's $7. It's calling it a Lux Box, and that actually plays off the idea of what they said was consumers thinking that fast food is luxurious right now. Now that box includes a Chalupa Supreme, a burrito, a taco, chips, nacho and cheese, and a medium drink, in case you were curious. But this promotion did just come out today. But let's take a closer look at the recent innovation that they launched with Cheez-It. They launched that collaboration, and the week of that launch, Taco Bell foot traffic jumped at the highest point so far this year. And taking a closer look at Starbucks foot traffic, innovation also played a big role for them too. In early May, Starbucks launched that Popping Pearls, that boba light drink, and in line with that, foot traffic also saw an uptick. And then in early June, we saw right here, it launched its pairing menu, so we're beginning to see a slight uptick from that. KFC, well, they have a lot of catching up to do. It's still seeing negative foot traffic, but it did rebound from a 14% low earlier this year, and foot traffic is down nearly 6% following that introduction of its value meal back in April. But now, all eyes are on the month of July. We want to know next month and at the end of June to see if these value meals and innovation truly do change the narrative that consumers think that fast food is too expensive, and if customers come more frequently, they spend more when they do go to these fast food chains, and if they come back at the end of these value offerings. That's what's key here. We want to see the return of these customers.
All right, Brooke, thank you for that. Appreciate it. KFC, McDonald's, and now Taco Bell. Diners looking for a deal are in luck, but what does the resurgence of the meal deal mean for investors looking for value? We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined now by John Tower, Director and Restaurant Analyst at Citi. John, it's good to see you. So, and you are the perfect guy to talk to about this, John. You know the sector, you know these names. I guess big picture to start there, John. Do you think it's going to work? All these value meals that are being rolled out here. You think it's going to mean more people come in the door? It's going to boost traffic, John?
Yeah, look, I think there's a very good chance it does work, at least stop the bleeding when it comes to traffic. That's been the bigger problem. It's been decelerating for quite some time now, mostly due to the fact that, prices have moved well beyond food at home inflation. I think there's about a 700 basis point gap between the two since pre-COVID. And, restaurants have been on the wrong side of it. This will help at least stem some of that tide in terms of the traffic loss. And the big thing that the restaurant brands will have is a marketing budget to blast this in front of every consumer everywhere they consume media, whether it's on their television or on their mobile device. You will see more and more price pointed offers hitting consumers right in the face.
But John, will margins be sacrificed in the process? And if so, are there strategies that some of these companies can implement to protect their margins?
Yeah, a lot of these operators have gotten much better about protecting profits when it comes to focusing on value. So they lean more on bundled value meals, hence the $3, $4, $5, $6, $7 starting price points or bundled value offers that are out there, rather than just straight up discounting menu items individually. So I think you'll see a scenario where profits don't necessarily take a nosedive as the mix of value continues to grow higher on these menus. So, I'm not all that worried about the profit piece. And keep in mind as well, a lot of these operators are franchised, and therefore, they're not seeing it directly on their own P&Ls. The franchisees will end up feeling it a little bit more at the store level. And that's frankly where a lot of the tensions come from here in terms of seeing these value platforms not be launched earlier, say in late 2023. There's a friction between franchisee and franchisor on where and what they're going to discount, what they're going to promote, and at what price point in order to get traffic coming back to the stores. But I think many of them have come to reasonable levels in terms of what they're going to promote, when they're going to promote it, how they're going to do it. And I think it should start moving the needle for traffic.
Let's get to some picks, John, that are interesting. You cover a lot of names. You got a big coverage universe here. One is McDonald's. And there, John, it looks like your rating is still neutral. You're on the sidelines. How come, John, and what would you need to see before you get more bullish on that name?
Yeah, there's been a few things. We've been a little bit more, I'd say, conservative on how they were coming into 2024 in terms of our expectation for sales domestically and across their global business. And to date, that's played out. I think, you don't necessarily want to completely bet against McDonald's on value, as that is core to their ethos as a brand. But I think we're going to have to see some consistent value running across the menu beyond just this 5-week window. And I know, some of the franchisees have signed up for something beyond that just 5-week window that they've talked about with this $5 meal. I think there's going to be more to come beyond that later in 24 with respect to value messaging, and probably more in 25, but we need a consistent message there, I think, in order for us to get comfortable. And then internationally as well, the softness that we've seen here is it's traveled across the globe, right? Whether it's Asia, whether it's Europe, if we can get confidence that those markets are not contracting or not slowing down any further, I think, then we can get more comfortable with where estimates are, and then get more comfortable with getting warmer to the stock.
And John, when you think about loyalty memberships, digital rewards, what companies are best positioned on that front? Because that feeds into the whole notion of value for the consumer as well.
Yeah, look, I would say the pizza category has been the leader with respect to digital for a long time. Then beverage has done a phenomenal job. It's not been until recently that a lot of the other fast food concepts have gotten better when it comes to loyalty programs, digital ordering. I think actually Taco Bell, owned by Yum, is revamping its program. You'll see it hitting in the third quarter of this year. It'll reduce some friction in the drive-through window, where I think that's been a point of pain for consumers in terms of utilization and frankly, wanting to use the platform on a regular basis and driving frequency. I think that revamp will help. The programs themselves to date, they've been more of a discounting mechanism. It's a way to communicate one-to-one with the consumer, but it's still TBD in terms of who's going to win in this over the long term. I like Taco Bell's revamp. I think they're going to move the needle in the short term as that program gets revamped.
John, appreciate your time and those stock picks. Thanks for joining us today.
Thank you. Have a good one.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including a one-on-one with McCormick CEO Brendan Foley to discuss the company's latest earnings report. Stay tuned for Market Domination Overtime. That is the closing bell on Wall Street, and now it's market domination over time. Let's see where the major averages ended up here. Allie, I'm going to use the word muted. I feel comfortable using that word. The Dow, we're up about 36 points. The S&P basically flat, tagged on about 5 points there. The Nasdaq leads your way. It's up about 0.3%. Of course, tomorrow, Allie, we do have some important inflation data on tap. We got May's core PCE. We know that is the Fed's preferred inflation gauge. Investors would like to see a good print there, maybe increase the chances that the Jay Powell and his policymakers do lower rates later this year, but we shall see.
Yeah, we shall see. And like we're seeing on our screen now, the NASDAQ, the leader here. And that's where I want to pick up this next conversation, because as the quarter comes to a close, we're seeing the concentration in big tech fueling a lot of those market gains, with Amazon hitting $2 trillion and Nvidia continuing to defy expectations. For more, we're bringing in Tushar Yadav, market strategist for BlackRock's target allocation business. Tushar, thank you so much for joining us. As we were just saying, there's been a lot of concentration when it comes to big tech. What are the potential risks there if we don't see that broadening out of the market in the second half of the year?
Yeah, listen, we could focus a lot on the risks. I think that's, again, tough for a lot of people because most people came into the year expecting some kind of broadening out. Maybe that whine that you're hearing is the noise of everyone complaining about the fact that we haven't had that so far. Listen, the market's doing its job. It is chasing higher fundamentals, and where you're getting higher fundamentals are in those pockets of the market that are driving earnings growth. By no surprise, that happens to be tech, or we like to call the tech plus, including some of those consumers, the communication services names that often get lumped in with that Mag 7, as you're showing on the graphic, as well as the growth names. And in our target allocation portfolios, which any advisor can follow on BlackRock's Advisor Center, and you can see what we're looking at buying and selling in our portfolios, we've been very heavily overweight this theme. And part of the reason has been because earnings have given us no reason to move off of it. And that's happened in the last season. It's been happening in the last few seasons that we've been seeing. It certainly isn't likely to continue into perpetuity. But until we see some sort of broadening in earnings, it's unlikely you're going to see some sort of broadening in the market. And absent some kind of major market macro catalyst, you're not going to have that happen. And just, as a sort of footnote to that, a market catalyst that's a big sort of major macro driver of stocks is also going to be a uniform condition for the growth names and for the tech names, just like it hurt them in 2022. So, for us, that's a reason to stay bullish in this particular area of the market where we're seeing above average earnings growth, where we're seeing, those pockets of the market really driving the market higher, and the market's doing its job in prices reflecting the reality that we're seeing in those stocks.
Tushar, it's interesting because you hit on one theme you'll hear a lot about. And certainly investors are focused on this idea. Well, we've had this rally, but it's been so narrow. And we've had any number of strategists come on that they throw a yellow flag at that. Tushar gets them a little nervous. The other theme I do want to get your take on is you'll hear folks kind of talking about the economic data. And we got more today and how whether is that calling into question the soft landing scenario, and maybe folks getting a little bit more skeptical? How are you feeling about that, Tushar? Are you in that softish landing camp?
Well, we've soft landed at this point in time. I think, talking about what type of landing we're going to have was a very 2022, 2023 conversation, maybe. I think you just have to look at the reality. The last Federal Reserve rate hike was, far, far in the past at this point in time. If there was some transmission mechanism that we were going to see an economic impact, we should have seen it by now. And I think we are seeing it in some pockets of the data. And it goes back to this broadening out. Sorry to keep harping on, where the challenge flags are coming from, or the yellow flags that are coming from. I'll throw a challenge flag on it and say, look, it's all related to some degree. And unfortunately, pockets of the market that rely on financing costs, that rely on the ability to have sort of, project shovels in the ground, things that are, going to be dependent on the cost to finance those projects, they're going to struggle, and they have been struggling. I think other areas of the market where you're seeing revenue in the door, you're seeing orders in the door, and you're seeing sort of strong economic activity are not. And the economy as a whole, I beg your pardon, is an amalgamation of all of that. And, some pockets of the market and the consumer have remained extremely strong. Some pockets of the market, certainly on the industrial side, and next week we'll see that continuation maybe on the manufacturing and industrial sort of data that's coming through, have not. And it is an unequal economy. It is an unequal economy for those respects. I think if we sort of detach ourselves from worrying about how we define what the economic cycle has looked like for the last 6 months to a year, and just sort of reflect the incoming data, continues to remain strong, but there is weakening at the margin. I think that informs us for how we want to look going forward, which is that we see a Federal Reserve that is on the precipice of having to sort of make maintenance cuts or look at cutting rates. Certainly comments from Rafael Bostic just before we started this segment reflect a lot of that reality, which is that higher rates have bitten the portion of the market that they were going to bite, but as a whole, the economy has managed to sort of weather that storm and has landed quite softly overall.
All right, Tushar, thank you so much for joining us, my friend. That was a great discussion. Appreciate it.
Thanks for having me.
Shares of McCormick higher today. It's after the seasonings maker easily beat quarterly estimates for earnings and sales. Yahoo Finance's executive editor Brian Sozzi is standing by with the CEO of McCormick, Brendan Foley, to discuss the most recent quarter. Sozzi, take it away.
All right, thanks so much, Josh. I appreciate it. Yes, man of the hour here, Brendan Foley, a couple hours removed from his earnings call. Thanks for joining us here on Yahoo Finance.
Great, thanks.
So tell us a little bit about the state of the consumer. When they enter that supermarket, what does your data show they're doing?
Well, we're seeing our consumer business grow right now, and a lot of it is we're meeting the consumer where they are. What we're seeing, though, is they're definitely, the consumer's definitely showing a lot and exhibiting a lot of value-seeking behavior. They're being really more selective on price points, and we definitely see that throughout the store. What we're seeing, though, in the perimeter is that we're seeing more shopping going on to the perimeter. People are looking, and when they usually do that, they're doing it because they're saving money or they're not eating out as much. And so that definitely gives an indication of where the trends are. Spices and seasonings are doing well in that environment, and they tend to do well because people want a way to flavor their proteins or their vegetables or whatever it might be. And that's just an opportunity for us. We're definitely seeing a lot of growth from that, and we're winning because of it in terms of unit volume.
Are you having to become more promotional in the items you get to get them out of the perimeter into the center of the store?
Well, you think about it, a lot of our products, with the exception of one or two of our brands, are in the center of the store. We actually have some brands also in the perimeter, too, that are doing really well because of that traffic. It's Gourmet Garden is one of the brands that we have there. But what we're seeing, I think, from a price point standpoint is parts of our portfolio, we took a hard look at them and made sure, are these at the right place right now to make sure that we're going to grow volume with the consumer, meet them where they are. So we did a little bit of, taking a look at some price points, make sure they were sharp enough to make sure they could grow volume. But it's also about driving more brand investment. We're doing a lot more brand marketing right now, and we're also launching a lot more innovation. There's a big focus around that.
Isn't this the perfect environment for your brand? The fast food companies, like you mentioned, traffic challenges. Isn't this the point people just hunker down in their homes and saying, I'm not going to spend $15 for a value menu at McDonald's. I'm going to cook a chicken breast at my barbecue?
Well, we serve all segments in food service, and it's a really diverse area, from quick serve restaurants all the way to independent restaurants and colleges and universities. And what we're seeing part of our business, we're actually seeing growth in our branded food service business. And there are segments in there that are actually doing quite well. And so for us, it's been a growth area. I mean, if you go to a fast casual restaurant right now, and you might see Cholula there on the tabletop or Frank's Red Hot, and that's opportunities for us. We're doing limited time offers with a lot of restaurant partners. One that we have, like with Wendy's, they launched their breakfast burrito.
I'm a big Wendy's fan.
They paired it with Cholula. So these are opportunities for us to continue growing and expanding our brands.
Talked a little bit about on the earnings call, Brendan, some weakness in the fast food channel and I guess packaged foods. Is the packaged food weakness, is that PepsiCo and because of the slowdown in snacks?
What we're seeing broadly, I think, in center of store is just slightly softer volumes than where people would want to be right now. And we're also, like you just said, saw it in the QSR channel as well. But broadly, when we take a look at our flavor solutions part of our business, and that's what you're mentioning there, we're working a lot with our customers on innovation, what their plans are for the balance of the year, and we feel we're a little bit more optimistic about where that will go because people are focusing on where they can meet the consumer and where they are, and we're seeing a little bit more activity there.
Any relief in inflation coming for households?
I think right now it's hard for me to tell what inflation is going to be in 2025, but certainly it came down, I think, broadly for everyone as we think about input costs. But still, this is something that consumers are really worried about. There's a compounding impact of inflation out there. And definitely, that's been, I think, still slowing down, I think, the overall growth that we've seen. Our business, though, we're starting to really, grow volume. We're doing really well in the Americas region, in the US, we're doing well in EMEA. I think we're finding a way to make sure that we work through that with consumers. And it's a whole holistic program that we got in terms of just increased investment, innovation, brand marketing, thinking about price points in the right way. We're finding a way to win.
This is a real interesting time for the packaged food industry. There has started to be the return of some deal activity. Your brand has been known to make big deals. Is there an acquisition to be had out there that drives more growth at McCormick?
M&A has been a part of our growth algorithm for some time, so that's definitely something that we always continue to look at. Having said that, it's also a priority for us to pay down debt, make sure we're returning cash to shareholders, but M&A remains a key part of our strategy. We're always looking at opportunities.
I can't neglect mentioning some of these products on the table. Grilling season, these are all things, creamy dill pickle mustard spread. I'm unsure where that product came from, but maybe you could tell us. And then what has been the start to grilling season for your brand? What are you seeing with consumers? Are they opening up their check or pocketbooks to grill up their meat?
We're seeing a great start to the grilling season. It's exciting as we go here next week. A lot of people are going to be grilling. I'm going to be grilling. I know you're going to be grilling.
I am going to be grilling.
And we see a lot of opportunity right now just in terms of all the brands that we have that really address kind of that summer grilling occasion. Frank's Red Hot. It's also going to be the French's brand. Grill Mates. Montreal Steak is a great favorite for everyone. The dill pickle sauce right there, that's an indication of how
spread, sir. It's spread.
Well, spreads, but it's that creamy dill pickle. Okay. That is an example of where we're seeing trends move. So we probably identified that trend a couple of years ago. It didn't come mainstream yet, and now it is.
Lastly, you have an investor day, and I'm sure you don't want to divulge everything that's going to be talked about there, but what should investors expect in terms of innovation in packaging, and where can you see this brand going?
When you think about the McCormick brand, we're already leading with packaging innovation just in our core herbs and spices portfolio right now. We started a big renovation in that part of our business last year, and it's now fully on shelf, or almost completely on shelf. And what's great about it is it's delivering more benefits to the consumer. And even simple things like printing the spice name on the cap with the Best By date.
I never actually realized that.
Yeah.
Okay.
So these are simple things, but we're also doing it so that we're creating packaging technology that leaves the product fresher. Before you get it. And that's a really key priority for consumers. So having fresher product, fresher spices and herbs is something that we built into this packaging innovation. We'll continue to look at packaging innovation. It's also about sustainability though. So in that particular package, it's 50% post-consumer recyclable. We have new Frank's bottles in restaurants now, and it's going to be colored red so you don't have to see through the bottle, but it's 100% post-consumer recyclable plastic. So every time we touch a package, we're also looking for sustainability opportunities.
It's innovation you can believe in, sir. McCormick CEO Brendan Foley, good to see you. Good luck grilling season. I hope you do not burn your meat like I will. Probably will. I appreciate it. All right, do stay tuned to Yahoo Finance. We have Nike earnings analysis coming out very, very shortly.
Nike's fourth quarter results are just crossing the wire right now. Let's get those to you. Q4 EPS 99 cents versus 66 cents. So that is a beat on the bottom. Q4 revenue comes in light though, 12.61 billion. That is versus estimates of 12.86 billion. Q4 gross margins, it looks like also did come in light again relative to expectations, 44.7 versus what was expected, 45.3. Greater China revenue though, that does look better than expected, just coming in better than expected. 1.86 billion, forecast on the street alley is 1.83 billion.
Yeah, it's interesting to see the reaction to shares right now. Now, they were positive, but now we're seeing them dip. We did see, like you mentioned, that margin miss, that revenue miss, although the EPS beat. And I think the China story is actually one to focus on because China has been a region that Nike has really struggled in. But I think what's going to be really important here is forward-looking guidance, the outlook. And I did see something that fourth quarter challenges is leading to an update to fiscal 2025 outlook there. And I'm not seeing exactly what the forecast is right now, but that tells me that it's not good, right?
Let me just correct one thing I said. Q4 EPS 99 cents. The estimate was actually 85 cents. I just want to make sure I got that right. That's still a beat on the bottom. I just want to make sure I got that correction in there. The initial reaction here, not great. We're down about 4%. And the stock had already underperformed heading into this print. Remember, I mean, year to date, it was already down about 13%. So at least initially here's some disappointment. Obviously questions for investors about that top line miss, I think will be front and center. What are the puts and takes? What did analysts not see coming, perhaps? And then broader questions, product innovation, China, Olympics.
Right, it's really about the future here, right? What can Nike do to reinvigorate itself, especially amid all of this intense competition? What new products can we come up with? How can we best position this company for future growth? Now, that being said, Nike has done some cost management, which has been positive on the street, but for now, it seems like investors aren't that impressed. But we want to break down these Nike results that are crossing the wire, again, beating estimates on earnings per share, while revenue coming in light of estimates. And here to dive a little bit deeper into this print is David Swartz, Senior Equity Analyst at Morningstar Research. David, thank you so much for joining the program. What sticks out to you here? It seems like we got a bit of a mixed bag, but shares are down more than right around 5%.
Yeah, I think the sales number is pretty weak, down 2%. So I was looking for a 1% sales growth number for the quarter. So the sales were light. I think that's probably the main concern. As you mentioned, the EPS was above estimates. I was at 88 cents and Nike reported 99 cents. That's really been common, though. Nike has consistently beaten EPS estimates in recent quarters. So probably people expected that, although some analysts had lowered their EPS numbers. It looks like mainly that the outperformance was due to lower operating costs.
Are you surprised by these the Greater China numbers, David? It looks like 1.86 billion. That does just beat the estimates, 1.83 billion. What are the puts and takes in that market for Nike?
I think that the China numbers are still pretty low compared to what Nike should be doing and can do in China. I think Nike can get back to double-digit sales growth in China. We haven't seen that recently. So I think that people are still concerned that Nike is still not really performing that well in China. Now, Nike just opened up a big House of Flight store in Beijing. Nike's been doing a huge amount of marketing in China, so it's certainly a big focus of the company, but it does seem that Nike's recovery there is taking a little bit longer than people probably hoped.
So David, how can Nike reignite and reinvigorate this sales growth? Does it all come down to that product innovation?
That's certainly a big part of it. We do have a lot of Nike products coming out later this year. Nike held a big marketing event in Paris recently ahead of the Olympics. Nike will be releasing a lot of products around the Olympics. They'll also be doing a lot of marketing and also a lot of new products in the fall and winter seasons. Most likely, we won't see a big impact on sales from the new products until fiscal 2025, probably late in the year, late in the fiscal year. So that's probably a bit of a concern for investors that it could be another couple quarters before Nike sort of gets back to sales growth.
And David, what is in talking back to product innovation, what's in the pipeline here that we know about that you think is going to excite consumers and investors?
Well, Nike has a lot of new running shoes out, new technologies, new versions of Air and its other main products. We'll have to see exactly, whether any of them are big enough to drive sales. It has been some years since Nike put out Vapor Max and other top-selling products. We haven't seen necessarily things recently that were too innovative in the sense that they drew customers away from competitors, and we have seen competitors like On especially that have probably taken some share from Nike. So we'll have to see, but definitely Nike is investing heavily in new shoe technology.
And how do you think the economic environment is playing into this? When you think about discretionary spending, high inflation, is that something that you're seeing impact not only Nike, but a lot of these competitor brands as well?
Yeah, definitely. The sportswear market right now is pretty uneven. Most of the companies in this industry have said that, including Puma, Adidas, Under Armour, and others. Now, we have seen some that have performed well. Certainly, Dick's Sporting Goods, for example, in the U.S. has been doing fine. Some other sporting goods stores haven't been doing quite as well. So we have seen kind of a mixed bag from both the manufacturers and retailers of athletic products. But generally, I'd have to say that the economic conditions are not entirely favorable. We have seen a shift in spending, I think, towards travel and away from consumer goods and apparel and footwear specifically.
And we should know here, David, that there's a statement by execs too here. CFO talked about how their fourth quarter results highlighted challenges, he says, that have led us to update our fiscal 25 outlook. I'm just trying to think about potential catalysts ahead, David, here. Some folks point to the Olympics, of course. Is that a potential tailwind for Nike?
The Olympics itself probably does not generate a lot of significant sales for Nike, more than it would normally do, but it is a marketing opportunity. And Nike also will benefit from other major sporting events, including the Euro Cup, which is currently going on right now. But it does provide Nike with a more stable product development cycle. The last Olympic cycle was really messed up because, of course, the Olympics were delayed by a year, the Summer Olympics, and then there were no fans in the stands, and it really did not work out as normal. So I think that Nike is excited to be back towards a normal athletic cycle, and that does affect Nike's product cycle and its marketing plans.
Earnings call is right around the corner here. What do you want to hear from management when it comes to this report? Is there anything management could say to alleviate some of the investor concern that we're seeing play out in the stock price right now?
Yeah, definitely the gross margin is not up to where it should be. And Nike had told us that gross margins would start to recover. So that's something that will definitely come up on the call. I also think that we'll hear some commentary about the sales outlook in the major regions, North America, Western Europe, and China. And we'll see, what they say about when those markets may be getting back to stronger numbers. Certainly, in terms of China, it's getting back to probably double-digit sales growth. And then in Western Europe and North America, it's back to positive, sales growth in maybe the mid-single digits. So we'll have to see if we get any guidance from Nike about how many quarters it may be before we start to see numbers like that.
David, always appreciate your rapid-fire response and reaction to these reports. Thanks for joining us.
Thank you.
Time now for What to Watch. Friday, June 28th. You're going to start off on the economy. New personal consumption expenditures, or PCE, data coming out in the morning. Economists forecasting total PCE to cool down in May. Core PCE also expected to decline compared to April. The Fed's preferred inflation gauge providing another piece of the economic puzzle as the central bank continues to deliberate potential rate cuts.
Also coming in the morning, the final consumer sentiment print for the month of June. Economists expecting that number to tick up slightly to 66 compared to the previous June reading, showing a little more optimism about how consumers feel about their finances.
And finally, we're going to be getting another round of Fed commentary. Richmond Fed President Tom Barkin will speak in Paris at a global interdependence conference early in the morning. And then after the PCE data comes out, Fed Governor Michelle Bowman and San Francisco Fed President Mary Daly will speak. Bowman suggested earlier today that she's not ready to cut rates.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The S&P 500 trading near the flat line in today's session. This is investors wait for tomorrow's big inflation print, but the Fed's fight to 2% may have an adversary, elevated shipping rates. Plus, what goes up must come down. Space junk is becoming a big problem for Earth's orbit thanks to overcrowding from satellites. So how does one ditch the debris? We're going to hear from one startup trying to solve that problem. And regardless of who you're voting for in November, you may have reason to celebrate this year. Election years with an incumbent in the running have historically been solid for the broader market. We're going to take a closer look in our chart of the day. Now, shipping rates just keep sailing higher. Shipping consultant Drewry's World Container Index rising 4% this week and is up more than 250% from a year ago. Since October, escalating violence in the Red Sea has kept rates elevated as ships favor longer, less risky routes. And joining me now to talk about all this is Craig Fuller, founder and CEO of FreightWaves. Craig, it is good to see you. There was an interesting article today, Craig. I don't know if you saw it. It was in Barron's, just talking about this very topic and talking about how shipping rates have soared. That according to the report, Craig, sending goods around the world by ship is at least 5 times as expensive as it was last year, Craig. I mean, that stat just jumped out at me. Help us explain that, Craig. What is driving that?
Yeah, Josh, this is a big topic in supply chain circles, is what's happening in the ocean market, really driven by 2 things. One is import volumes are much higher than expected and continue to be incredibly robust. It tells us that retailers are pretty confident about consumers in the second half, as well as they are pre-positioning products to prepare inventories for potential labor issues on the East Coast, but also tariffs that may come with the new administration should we see change in the election. So that's one issue. And the second issue is there is a little bit of because we've had geopolitical disruptions, particularly with the Red Sea, we've seen a risk premium put on it, almost a war risk premium that the ocean shipping container lines are passing on to their customers.
So Craig, just to dive into that issue specifically, so what you're suggesting is, so because we have Houthis attacking these vessels, the vessels, Craig, have to actually go around Africa. They can't use that shorter Red Sea route, and that's meaning increasing, obviously, time and costs?
Yeah, that takes capacity off the market, because if you think about it, the capacity constraint is how long it takes to ship from point A to point B. And if having to add time, it just takes a lot of available days of capacity off the market. And that's exactly what's happening. But also, I think the shipping container lines, I mean, they have a massive amount of market share. The top 10 container lines have 90% of the market share in containers, and historically have been bad at managing price and passing those some of their costs onto consumers and managing their ability to manage price. Since COVID, they've gotten their act together and have been able to really have an enormous amount of pricing power over their customers, and we're seeing that play out on the market right now.
Are there certain companies or certain sectors, Craig, that are going to be more affected than others? You know, is it car makers or apparel makers, for example?
Yeah, most of what you see in containers is consumer and retail centric. So 75% of the imports that come in containers are actually consumer goods headed for retail. So these are products that you would see at a big box retailer or potentially online e-commerce. That's the majority of products that move in containers. The stuff that we typically think of as raw materials is not moving historically in containers, a lot of the raw materials move in bulk, and that's like an entirely different market. The good news about the fact that we're talking container specific is we're talking about one part of the economy, which is consumer consumption, and not really related to wholesale input costs. So a lot of what you see in terms of the transportation cost and those retail goods, transportation is a relatively small piece of the actual cost of goods sold. So consumers will not see an enormous impact in terms of inflation on what they actually buy or erosion of their pricing power versus what you would see if this was raw material input goods, which tend to show up in all sorts of manufactured items.
Oh, interesting. And bottom line, shipping rates, Craig, if I asked you to take out your crystal ball here, I mean, where do you see those headed? Are we going to stabilize here or do we keep moving higher?
Yeah, I think this is the time of the year of the next 2 months where we'll see peak activity. Ocean shipping container volumes drop precipitously in October. So what you're seeing right now is really a prelude for what you'll see for the rest of the shipping season. And so it is going to stay pretty high. But like I said, I think consumers are not going to experience the level of price increases or inflation that they experienced back in COVID. These rates are much lower, even at $7,000 a container. It's much lower than it was during COVID when we were up to $20,000 a container. So it won't be as significant. And the most important thing that drove a lot of the inflation was really the lack of products that we saw during COVID. And that's not happening right now. There is no shortage of capacity to move transportation. This is merely a pricing issue that retailers are having to contend with in their input costs, but it's going to be marginally impactful to consumers.
I want to get you out on this, Craig. It was just something you mentioned. I want to come back to it. In the U.S., how there apparently a strike by dock workers, Craig, could be coming. Tell us about that and potential impacts.
Well, this happens every couple of years somewhere in the North America where we see the threat of strikes. So a couple of years ago, it was the West Coast longshoremen that was a discussion. They ended up not striking. They ended up threatening to strike, but those issues were resolved. We saw Vancouver and British Columbia dock workers did end up striking. That did get resolved. We're now seeing it play in the East Coast. So these things periodically pop up. We see shippers have become very accustomed to that. These are companies that pay for shipping services, have become very accustomed to these types of labor disruptions. And so they will route products to different parts of the country. So there is some good element in this, is that this is the East Coast. And because it's the East Coast and not the West Coast, is that most of the items we expect for retail tend to come through the West Coast and less so on the East Coast, so that shippers can plan accordingly and use other ports because they have the alternatives. West Coast strikes would have been far more disruptive.
Craig, a big, important topic. Thanks for taking the time to walk us through it. Appreciate it.
Thank you for having me.
U.S. stocks closed little change as investors assess fresh economic data while also looking ahead to the latest reading on the Fed's preferred inflation gauge. Yahoo Finance's Jared Blickery joins us now for more on the trading day takeaways. Jared.
Thank you, Josh. A lot of ink has been spilled about some of the moves that have been made in the market, especially the AI trade. But what do you do if you've missed the boat until now? Well, we got a lot of stocks and sectors to watch here. So let me just go through a couple of the recent things that are on my radar here. And I'm going to start with the Nasdaq 100. And this is where we see the action. By the way, all these returns are year to date. So Josh, I'm looking at Amazon here. This stock has really picked up over the last 2 days. But what I'm interested in is this pattern that has formed over the last few years. This is a 5-year chart. And what we've just traced out is this giant consolidation, nice cup there, tiny little handle, and we have broken to the upside, as we can see there. Now, I'm also taking a look at Tesla. Interestingly, both of these stocks are the two biggest components of consumer discretionary. What you notice with Tesla is there's a lot of consolidation in here, and I'm interested in a pattern that's happening in this year. So I'm gonna go down to a 1-year chart, and specifically with candlesticks, you can kind of see what's happening here. This is an inverse head and shoulders that's tracing out here with the potential neckline at about $200. we shoot above $200, I would expect some continuation. And this is a stock, a lot of people pay attention to it. So is it the next Nvidia, the next AI trade? I don't know, but I like it above 200.
All right, so big Amazon, Tesla, big well-known names. How about a little bit more under the hood, Jared? What are you seeing?
Well, I've also been tracking biotech, and this is something, IBB is a ticker I'm using. You can also take a look at XBI. Let's see if I can find IBB on here. And we'll see if we can chart this. I'm not seeing IBB.
No.
Unfortunately. However, I can assure you that it is there. Anyway, I'm looking at
I trust you, Jared.
Thank you. I'm looking at biotech. I'll show you one more thing. Here's XLC. This is the #1 sector of the year, so it is outperforming tech. Let me show you another 5-year chart. I'll put some lines on, and you can see here's another giant cup.
I've heard some folks say about this sector, by the way, a little bit like healthcare. They kind of see it as a way, they see the kind of offensive and defensive names in there.
XLC is such a catch-all. You got Alphabet, you got Meta in there, you got Verizon, AT&T, Netflix. What do all those have in common? Well, not a whole lot, but anyway, that's the sector. It's kind of a catch-all. So I like XLC, but I'm really watching Amazon and Tesla now.
All right, takeaway number 2.
Takeaway number 2. I'm on pins and needles here myself. We got market concentration. Yes, I was writing about this in the brief overnight. Published this morning, and I was looking at this chart from Bank of America. This goes all the way back to 1990. What we are looking at here is 3 months correlation of all the stocks within the S&P 500. So these spikes here, I'm going to show you, this happened during the pandemic sell-off. When correlations rise steeply like that, because everything is going down. So you don't want to see that if you're a stock bull. When you get down here, what you're thinking is, well, maybe we're going to go back up here. But the point Bank of America is making, we've been down here several times, and guess what? Look at the early 90s to mid 90s. You had years and years just staying at that level. So the concentration that and this is what we're measuring, market concentration, this can last for a long time.
In other words, the rally is narrow, but a rally can stay narrow for a while.
Yeah, if there's no big catalyst, if everything doesn't fall off together, you can just kind of persist this way for years.
Take it easy, relax, enjoy it.
Yeah,
Number 3.
Drink. All right, VIX seasonality.
Seasonality, my favorite.
Yeah, thank you. Yeah. We've been talking about stock seasonality. Now we're going to do VIX seasonality. So when the VIX spikes, that's the fear gauge. And let me show you. This is this purple line is the average of the VIX. Throughout the year, going back all the way to 1990, that's when calculations began. And the cyan line here is what has happened so far this year. And so you can see it's not a perfect correlation here, but it kind of fits rather well. And if you're taking a look at the next potential spike, that's when we would expect the next downturn. That would come at the end of July. So, maybe something to keep, but you'll notice until then, pretty low. So maybe we get a rally.
How does this seasonality kind of map with the other seasonality trends you've been bringing us, Jared?
I showed this chart last week, and this is the first 10 and the last 10 days of every month. And what we're seeing here is the first 10 days of July, by far the best performance of the year. This is just on average, so it doesn't have to happen this way. But if you're putting this all together, the VIX seasonality plus this probably got some tailwinds until at least the end of July. And if you're really paying attention here, the big spike up in the VIX, that tends to happen in September, October. That is primetime crash season.
All right, Jared Blackberry, great takeaways.
Thank you.
Thank you. Still to come, Space Week here at Yahoo Finance. On the other side, we're going to take a look at one thing that's become a major problem, space debris. We'll discuss when asking for a trend returns. Reaching sustainability beyond Earth and into space, there are thousands of satellites currently overhead with more than 9,000 metric tons of space debris in Earth's orbit. As thousands of more satellites are on track to launch through the end of this decade, we're taking a closer look at how to clean up this space junk. Here with more is Luc Piguet, ClearSpace founder and CEO. Luc, it is good to see you. So let's start when we talk about space debris. Space junk, Luc. What do we mean by that? What are examples? And how much of a problem is it?
So I think that the space debris are typically caused by either rocket bodies or satellites that are at the end of their life or that failed in orbit, and that essentially generates that remain in orbit because of their velocity. Right, to keep something in orbit, it has to go at 28,000 kilometers per hour in low Earth orbit. And those objects remain there and become essentially a projectile. Over time, what can happen is that those objects go through fragmentation events that are caused either by a collision or an explosion on board, and can generate very large fields of debris, which all continue orbiting at the same speed. So this is a major issue and is actually rapidly increasing in low Earth orbit in particular.
And Luc, who's creating a lot of this space debris? I mean, is it the U.S., China, Russia? Who's responsible for a lot of this?
A little of everyone, right? A lot of debris have been created by anti-satellite missile tests in the past. Today, there's a lot of rocket bodies that are from Russia. There's rocket bodies from China. There's obviously American objects as well. There's some European one. There's a long list of objects that are up there. They're typically cataloged, so we know who owns which object in general. And then a lot of objects come from collision. In particular, in 2009, there was this collision between the Cosmos and Iridium satellites. So Cosmos was a Russian satellite, Iridium, an operational American communication satellite that collided and generated a large field of debris. But it's a big mix up there, which belongs to a little of every spacefaring nation.
And so, Luc, so the purpose of your company is get there, clean it up, clean out this space debris. How do you do that?
So what we work on is developing, if you want, a servicer or a tow truck for orbits. We developing this. The intention is to go pick up larger pieces of debris or larger objects in space, and then help them support them for their re-entry, getting back under control, and then make sure that they re-enter into Earth atmosphere. Once you're able to do that in orbit, you're actually able to provide multiple other services. Essentially, what happens right now is that the space debris problem is, if you want, a side effect of an industry that doesn't have any servicing capability. Still, like if you would be operating the road transportation industry for 60 years without tow truck, you would have broken cars everywhere, and that's more or less what we have in space. If you think about it, the road transportation industry has servicing and maintenance and intervention integrated into it. So does the aviation industry or the shipping industry. This is not the case with the space industry, which could not have that kind of services in orbit over the past years. Today, the technologies make it possible, and that's what we're building.
A tow truck for space, Luc, as you put it, I mean, it does sound expensive, Luc. I mean, who pays you for this? Do you look to governments?
So in the first phases of our development, it's essentially institutional mission that we're leading. Today, we have a mission with the European Space Agency for about 100 million euros. There's another mission we work on with UK Space Agency. There's a third mission where we work on the life extension, the capacity to capture satellite, extend its life. And most of the initial phase of development and non-recurring engineering costs are essentially driven by institutional mission. On the long term, we think that is essentially the beneficiary of the space infrastructure that will pay for the services that are needed. What happens today is that launching states are liable for the objects in orbit as long as they remain there, and will require, probably as things move on, more and more expand the requirements for satellite operators to make sure that they leave a safe and sustainable environment behind them. And this is we can already see this trend. The US FCC moved from 25 years authorized for satellites in orbit to 5 years of authorized time in orbit after the life of a satellite, operational life of the satellite. So those changes are probably going to generalize across the globe for all the different launching states and requirements for satellite operators or agencies alike.
So just so I'm understanding, Luc, because that's interesting. So are you saying there's sort of efforts now to stop the problem of space junk, space debris, before it even becomes a problem? Meaning you create spacecraft that's sort of designed or programmed to kind of deorbit on their own once the mission's over?
So most of the satellites today are programmed to deorbit themselves on their own at the end of their mission. Now, there's two problems happening is that, in general, satellites, there's a certain percentage of failure in orbit. This means you cannot guarantee 100% that the satellite is going to be able to deorbit at the end of their mission. The space environment is particularly harsh, which makes it even more difficult. But beyond that, there's other cases where, for example, if you've got a really large satellite, which is, let's say, 2, 3, or 4 tons, a lot of the propellant of the satellite, it will be used just for the deorbiting, because you cannot just drop it wherever over the surface of the Earth. You need to deorbit it over the South Pacific, where there's no human life. Right, and this requires a huge amount of propellant. In those cases of satellites actually could use their propellant to extend the life of the satellite for several investment cycle, and then use the servicing to deorbit them. So there's different use cases for the kind of services that we're building. But in principle, it's either removing satellites that cannot get removed by themselves, or satellites where actually the economics of assisted removal makes a lot of sense.
Luke, it is such a fascinating topic. Thank you so much for taking the time to join the show and walk us through it. We appreciate it.
My pleasure. Thank you for having me.
More Ask You for a Trend on the other side. Citi Global Markets out with a new chart measuring the impact of election years on different sectors. Yahoo Finance's Alexandra Canal joins me now with a closer look. Allie.
Hey, Josh. Yeah, so ahead of tonight's first debate between President Joe Biden and former President Donald Trump, I thought it'd be appropriate to take a look back at how some of the major sectors and indexes have performed during an election year. And as you can see, a bit of volatility across the board demonstrated over here by the VIX, with modest gains in the S&P and the tech sector. sectors. However, once you have an election year with an incumbent president in the running, we see that volatility goes down and the average returns of those sectors, along with the S&P 500, go up. Now, Citi argues that this is driven by investors pricing in the potential for continuity in policy. So bottom line there, the return of an incumbent president often reduces the possibility of a policy surprise in any form. In the information technology sector, that's typically the best performer during those years, and by a pretty substantial margin, I would say, as well, the tech sector being right there. But now I want to take a look at what we're seeing year to date in 2024. We're just far and above the averages that we've seen in the past, with the exception, of course, being real estate all the way down there, as the housing market remains in recovery mode amid this high interest rate environment. But I will say that those high rates, it's not stopped the rest of this market. We see tech, we see communication services significantly ahead, while the VIX is down so far this year. The S&P has climbed about 15% year to date. Typically during an election year, we see gains of just over 11% there. So clearly what we're seeing so far in the market shows that there's potentially more room to run here.
All right, Allie, thank you. We appreciate it. That is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.